Hello, this is Peter with Quantum Edge AI, and we're going to be discussing the double diagonal and how to deconstruct this trade in order to make the best delta neutral, not the necessarily the best, but the most optimal delta neutral trading strategy given Quantum Edge AI's forecast. So let's think about this a bit. First is a delta neutral trading strategy. We have theta range positivity from 436 all the way to 408.90. Now, we can adjust these positions in any way you see fit, but first, let's deconstruct it from the option chain. So from the option chain, what does this mean? We want to be short these positions, long this duration, so short this duration, long this duration, and we're going to be short the put, short the call, on the front week. We're going to be long the call, long the put on the back week. Now, you can structure this in any way you see fit. You can short this week, you can long back weeks further out. But this is the way I I see it that should be the most optimal. You have the high forecast here, you have the low forecast here. You have information that Quantum Edge AI is guiding you to better trade, to better set your trades in the optimal locations. So how do we construct this? What we want to do is say, okay, well, what's the high forecast? The high forecast is 429.84. So we're going to sell the 430, let's say, and then we'll buy the back week, the 432.5. Okay, where's the low forecast? 413.13. So maybe we will sell the 14.12.5 and buy the 14.10. So I know I said this is a delta neutral trading strategy and this is slightly negative, but you can also adjust them, adjust the wings to meet your criteria. Now, if you look at the threshold for positive theta decay, we have 409.15 all the way to 433. So what's that? 409 over here to 433, 433 around here. So within this range, you are going to be, as long as you hold this position to expiration and price is between these positions, you're going to be in a good spot. You're going to be P&L positive. And we can also look at break even, say, okay, well, according to TOS, I'm not a huge fan of the probability here, but this gives you a rough estimate of what the probability is that price is going to be in between this location. Now, I like to look at it from a 2% step. What happens in the event that that Microsoft increases substantially or decreases substantially? Now we can adjust this to look a little further and say, okay, well, what is the finite risk on, what is the risk on the way down? What is the total risk on the way up? Um, and this is a finite risk trade. This is a delta neutral trade. This is theta positive. This can be delta whatever you want. Um, but I would say the best way to look at and trade options is to look at the the channel, to look at where these forecasts are and use them to construct where the option will not be and where it is likely to be. So according to our forecast here, we believe that price is going to be oscillating. It's highly likely that price is going to be oscillating in between this channel. We have a little bit of bias to the downside, but we have a delta neutral construction here, in my view. So anyway, this is one way to construct this trade. Um, we can be a little bit more aggressive. We can adjust these to be uh, a little bit closer. So say, for example, we want to uh, bring up the put. We want to bring down the call. Now, what that does is it generates a higher theta decay. It does, although, increase our risk somewhat by roughly 50%. But you want to take into account um, the risks, the uh, the commission of being in the position. What is this trade? Um, so how much is this trade going to cost you also? You have to take that into consideration. So to open this position is $2.60. To close it is $2.60. So round trip is $5.20. So you have to keep that in mind when constructing this trade, because what is your goal? Your goal is to arbitrage this theta decay. You want these positions, the short positions, to be out of the money at the end of this week. So what we're examining is the quantum edge AI forecast here. And what we're trying to say is, okay, well, where is bias? Two things. Where is bias and where is price likely to be? In this case, we can say that this is a good location. We can say, oh, we want to be slightly delta negative. We want to be theta positive. But in the event that price gaps up substantially, like say, for example, price moves up here, 450, we're going to be over here. That's not, it's not terrible. It's not incredibly likely, but it's possible. So you need to, when you construct these trades, you need to be wary of what is the potential probability of certain things happening, and what is your total risk at any one time. So, which is more likely in your view, that we have a strong gap down, or we have a strong gap up? What is the surprise event potential? And then what is likely to happen? So what's likely to happen is that price oscillates in between this area and we net this premium. That's just the reality. That's what I believe is factual. But we don't know that for certain. So that's why we have to be careful. We have to establish finite risk, know potential surprise events, and trade accordingly. So where are we now? This is a net debit. Your total risk is $750. Well, not your total risk. This is your total margin. Your total risk is $1.25 according to this. So is $1.25 times 100, $125. So this is your actual potential loss. According to them, they say your buying power effect is 874 decrease. It's probably because they're afraid of an individual being in the money at this position, being in the money at any one of these, and rolling out the position is a little bit um, tricky if you're in the money. So if you've been in this trade a couple times and you've been in the money, um, rolling out the position is not difficult. It's just it takes a little bit of thought. And when you're over here, you can say to yourself, okay, well, this is a bit scary. But the truth is, this is the reality. Your risk profile is the reality. Always construct your option spreads using the risk profile. Never send a trade without looking at the risk profile. Always look at this. Always look at the quantum edge high and low forecast, the close forecast, where it's bias, and use these tools to be within your risk parameters. Say you have a $100,000 portfolio. How many of these am I going to purchase? What is my risk? What is my total risk? What is the cost of the spread? So say for example, we have a midpoint of the bid-ask spread of 1.24. Natural is 1.3. That's not actually too bad of a spread. Maybe you want to locate this and say maybe I'll place my order at the 1.22, slightly below the midpoint, and wait and wait and wait, and I'll get a good fill. Maybe that's your style. Maybe you want to be more aggressive, and I know the positions. I know where I want my positions to be. I'm going to be located in this position, so I'm going to put it at the midpoint. I don't care if it goes a tick or two below. I'm going to take a minor hit. What I would recommend though is to be slightly below the midpoint, send off the order, adjust the order, be careful. Do not give away anything. Get involved in get involved at the best price. See, now the midpoint's 1.23. Maybe you could scale it, get in at 1.2, and really right when it hits, maybe you get entered and you get that fill. You want to be cautious um, about this and be as risk averse and scale in and enter um, at opportune moments. You know that this thing is going to oscillate. It's not just going to ramp up immediately. This is a delta neutral trading strategy. So what does that mean? The price slowly increases, or unless you have this gap up or down movement, we're going to see, potential loss. So that is the overall risk to reward. You're hoping, or you're projecting, not hoping, we're hoping and projecting that price is between this area and that there is no surprise event. That is the nature of this trade, and that's what you want to benefit from, is the basically this movement here. And even this here is not the worst in the world. It brings it back down, and this is a nice delta range. Now what you don't want to see is this gap movement lower. Now, this is a very rare movement, a very rare movement. But even in the event that you were here and you were here, you're not taking, let's examine what that would have. 426 to say 411. You have a 15-point move. So this is basically what that would happen in this case if you were to trade another 15-point gap down, which is extremely rare for Microsoft. A 15-point gap down, let's say from here, 15-point move to would be 407. So let's look for the 407. And in terms of your delta move, you're going to be negative 80. I mean, that's not that bad considering your theta decay is 24. You probably won't even be negative because of this implied volatility movement. So say, for example, it gaps down, implied volatility, it ramps up. This trade actually benefits from the volatility adjustment. So let's say we have an implied volatility increase of 10%. You're actually going to be positive. Your actually P&L going to be positive here. So that's why I say always place an exit strategy for this. And what is your outlook for this trade? Your outlook should be netting this theta and having a slight delta movement. So say, for example, price does decrease to 417.84. I would be looking for, it depends on your time horizon. Do you want to hold this to expiration? Do you want to get in and get out? Do you want to set a profit target in an area um, that is beneficial and get in, wait for the trade to come back in an interesting area, and then get back involved again? You can be adjusting the specific legs in any way. You have the call side diagonal, you have the put side diagonal. You can be getting in and getting out based upon the legs. You can be adjusting each one of their contracts, the long or short positions, in any way you see fit, in order to adjust based upon your outlook or the quantum AGI forecast outlook. So That is basically the double diagonal. If you have any questions, I provide my email. You can direct email me. You can leave commentary in the YouTube. I would greatly appreciate the like and subscribe. We're going to go through um, all different types of strategies basically in this analyze. So we're going to go through most of these and how you can potentially construct trades that are highly probable wins. Thank you.